One of the biggest problems when building a successful property portfolio is tax. Now, it's actually a good thing because you only ever pay it on the profits. But in this video, I want to deep dive how you can mitigate your tax in a legal and efficient way, specifically with flips and capital gains tax. And if you're interested in property and you're new to the channel and you want to learn more about property investment, business, and scaling a successful trip into financial freedom, this is the channel for you. So make sure to hit the subscribe button. And if you get value from this video in particular, make sure to hit the like button so it helps reach people just like you. Let's jump in. What is capital gains tax? So it was actually introduced in 1965 by a guy called James Callaghan when he was, he was Chancellor at the time. And he thought, yeah, this would be a great opportunity to tax people. And that's when capital gains tax was born, and it was reformed in 2008. And what it is a tax on your profits from disposing of assets. So it's not an income tax, it is not a company tax, it is capital gain. So if you sell something and you make a profit, you are taxed on the profit increase that you get moving forward. Now, what's important on this is you do not get any form of tax on your personal residence, okay? So if you buy an absolute shithole property that you live in, and you're refurbishing it and you sell it on and make 100 grand profit, you have no tax to pay whatsoever if it is your personal residence, okay? It's only on investments and stuff like that. So the first thing you need to know is, well, let's just put that in, not personal residence. The next is there is an allowance, okay? Most taxes have an allowance. There is an allowance every single year of £12,300. Now, what should happen is it goes up every year because things get more expensive, you make more profit, so you usually get a bit more of a gap at the bottom. Unfortunately, in the 2021 financial announcement, which was a few weeks back now, they have said it is going to be frozen. Let's get a nice blue on that. It is going to be frozen until 2026, okay? So that is not good news. All taxes are frozen until then, so it doesn't really help anyone out, but you get £12,300 completely tax-free from your profit every single year, and that's important, and we're gonna get back to that. And by the way, financial year, April the 5th, or 6th, April the 5th, every single year. That's important, we'll get back to that later. Before I get into how to mitigate this tax, how much are you actually getting taxed anyway? Well, I don't really understand the logic of this, if I'm completely honest, but capital gains tax is linked, or how much tax you pay is linked to your income tax, okay? So there's capital gains tax is like 10% on most stuff, but in property, it's different, okay? So here's how it works. I'm gonna focus on property. If your income tax band is the lower tax band, you know, the 20%, so your standard rate income tax, then what you pay is 18% capital gains, CGT, capital gains tax, okay? So you will pay 18% on everything above the £12,300 profit. I'm going to do a worked example of this at the end so you can see how this all breaks down in a real example. If you are in the higher tax bracket, you know, the 40%, higher tax for income, you are going to pay 28% capital gains tax, because if you're doing well for yourself in this country, you better be sure that you're going to be taxed on it. So that's how it works. Yes, it is frustrating. It is incredibly annoying. Nobody wants to pay tax, okay? Everyone wants to pay their fair share, but if there is a legal route for you to cut back your taxes in an efficient way without dodging tax, I'm all for it personally, and why wouldn't you? Everyone else would take advantage of the same loophole. So now that we know how much they're trying to get out of your pocket, let's go through the ways to keep it in your pocket. So how do we protect this money? Well, first of all, there are tax wrappers, as they are called. The two most common are ISAs and pensions. So if you want to take control in some way, ISAs and pensions do not need to be somebody else manages it. It can actually be you, okay? So ISAs, if you want to invest in property still, you can put it in there, protect the income, and you can look into REITs, R-E-I-Ts, real estate investment trusts. I'm not big on them personally, but they are a great lower risk way of getting in, just my opinion, not financial advice there, into property, and you do not pay any tax whatsoever within an ISA. You are currently limited to £20,000 per financial year to put into an ISA, and that tends to go up every year. Alex, if you could put the in the description a link to the ISA Millionaire video. If you guys after this want to check that one out, that could be a nice little one for you. And then in pensions, you have something called a SAS, S-S-A-S, I always get that wrong. Small self-administered scheme, okay? And what you can do with that, please seek financial advice on this, but what you can do is you can put a hella load of money in there, and then it's protected, it's wrapped, okay? And then you can invest that, you can loan 50% back to the company, to your company at low rates, and then you can utilize it however you want. But you can also put it in a lot of different types of property, mostly commercial, but there are ways of doing it in residential, but this is not the video for it. But if you are investing for growth over the long term and you're not needing any of that money to come out in the meantime, it's a great way to protect that until retirement age and just build and build and build, and you don't pay any tax whilst it's within those tax wrappers. So it's at this point I ask you, if you haven't already and you are getting value from this video, just do me a favor and lightly tap the like button. It really does help push this out to more people like yourself on the YouTube algorithm. So let's jump straight into another way to mitigate it is make a loss. Really, Jamie? You're telling us to lose money to save money? Hell yeah. Okay, you will be shocked at how much you can count as an expense towards your capital gains. Let me just give a little example here. You've seen my famous drawings, but you notice something different with this. This is a bit nicer than the average house that you talk about, Jamie. Yeah, it is. Here's my lake and my grass. Okay, I'm gonna stop because this is getting awful already. But this is Lord York's mansion, my holiday home, okay? Which I don't have, but it clearly does. So I've got my holiday home here. What if I do improvements to my holiday home and I spend 10 grand on that? Well, I want to register that. And this is where people just don't think. This is a great thing about having an accountant, right? Can I put this through as an expense? And that's the shift of mindset. Can this be a legitimate expense? Well, actually, improvements on a holiday home, yes, they are. Okay, so let's say I spent 10 grand. Well, that is a cost to my capital. So if I've made 20K over here, remember that 12,300 is tax-free. So there's 7,700 left that I'm going to pay tax on, right? Well, no, actually, because I made a 10 grand loss. So capital gains relief, or the allowance, the £12,300, cannot be carried forward. What that means is if it gets to in March or April the 4th or whatever day it is, and you haven't utilized that capital gains relief, you cannot carry that into the next financial year. Can you carry forward losses? The answer is yes, for 4 years. Okay, so I can build up losses on my capital for up to 4 years. Now, what's important to know is within property, when you are spending something, if something already exists and you have it rented out, it will count towards mitigating your income tax. If it is creation of something, it will count towards your capital gains tax. For example, if I improve a kitchen, that is income tax deductible, according to my accountant, and my opinion. And if it's adding a kitchen that wasn't there, that is capital, okay? But you need to accrue your losses where you can to mitigate your tax. So this is a big one people don't think about, is actually if you've got a spouse or civil partner, you can spread liability with them because you have your tax and their tax. These are two smiling individuals, Dave and Trevor in a civil partnership, yay. Dave has his rights and so does T-Dog over here. Okay, so what I mean by that is there's 12,300 allowance here and there's 12,300 here. Well, okay, Jamie, that's great, but what if I own the assets here? Well, actually, it's pretty simple doing a transfer between individuals. And if I transfer it to a friend, there's tax liability there. But if it's to a spouse or civil partner, it's very rare that there's tax liabilities on that unless you die soon after. Okay, talk to a tax advisor around that and don't die. Okay, so what I can do is, did I just say that on a YouTube video? Don't die. So what I can do is I can transfer that to my main man T-Dog over here, and then Trevor can sell the property and make however much profit, but the first 12,300 tax-free profit, baby. Okay, so it's really important to understand that you want to utilize everything you've got. And I understand not everyone has Trevor on their side. Okay, but if you do have a spouse or civil partner, you can transfer entities between you, usually with it's tax-free, but talk to an advisor around that. And that is how you're going to mitigate some further advice. And we're going to move on to something that I think is really cool. The next one is splitting multiple assets over multiple years. So what you can do is when you are selling properties, let's say you are selling 3 units, and these could make good investments for it. There are many institutions looking to portfolio buy. Okay, so let's say we are in March right now, and let's say each one of these is going to make 20k profit. Not a sale price, 20k profit, right? Well, what can we do here? Well, okay, here's what we're going to do. Well, my man Trevor, my civil partner in this case, he's going to get a property sent to him. And then he's going to sell it. We're going to get 12,300 for free. And then the 7,700, I'm going to make sure that I'm at 20%, which, by the way, if you're being strategic about your tax, you're probably paying 20% no matter how much you're paying. So I'm going to pay 20% on that, which sucks, but I'm going to pay the 1,450 tax on that. But that is a damn sight better than 3,600, which is the 18% on the 20k. What I'm also going to do is I'm going to sell one myself. And I'm going to mitigate that tax. So I'm going to pay another 1,540, but not 3,600 again. And then here's what I'm going to do. I am going to get the investor or buyer to put an option on this. Pay me a non-refundable deposit, and I'll put a 6-month option on that so it goes into the next tax year when they actually exchange and complete on there. Which means that it then goes into it, and I've got another, you guessed it, 12,300 allowance. So we've actually done this and helped a client do this before. So instead of making 20k profit or 60k profit and paying the amount that maybe they were meant to pay, which would have been the first 12,300 tax-free, and then the next 47,700 at 18%, so circa £9,000. Just being a little bit clever with this, instead end up paying about 4,500, splitting the tax in half. But this is all just a really basic level. What is truly the best shelter over the long term for you to make sure you are cutting down your tax to a bare minimum? The way to truly protect as much as possible is get a fence. Okay, get a fence around your property. What the hell are you talking about, Jamie? What I'm talking about is a ring fence. A ring fence or a limited company. Now, a limited company is really important for a lot of reasons, and it's all about protection. So first of all, you cannot get in. That was terrible. And you cannot get out. It has its own structure. Now, the thing is, when you have property here, people don't seem to be able to get their heads around this. Let's say big muscles and a smiley face and full head of hair. I was about to draw something else then, but I won't. It's for the YouTube. There could be kids. This is me, obviously. Good looking fella that I am. I own the company. I don't own the properties. I'm going to say that again because people don't seem to be able to get their head around this. Most of my properties that I own, I don't own them. Okay, we talk about it like, oh, I own it, but no, actually, I own the company and the company owns the properties. I'm going to say that again. I own the company and the company owns the properties. It's really important to get your head around because I don't pay tax on something I don't own. I'll say that again. I don't own the properties, so I don't pay tax. My company pays tax on them. And that's really important because actually, there is no such thing as capital gains tax. Within that, there is corporation tax. A corporation is a bit of an Americanism, but a corporation is a company, a firm, a business, whatever you want, in that corporate entity. So you pay corporation tax, which currently is 19%. Now, it was meant to go down to 17%, but good old CDOG had different opinions on that, and that impacted us. And now it's going to be going from 19 to 25%. Alex, put the link below to the financial WASU annual review budget thing. I'm a professional speaker, people. Put it below and make sure you have a read of that because it's not as bad as it sounds, 19-25%. It's actually got a scale on it, and I put my opinion on the economics of that and how it's going to impact us. But this is really important because within that fence, you have a couple of things. First of all, you have corp, not capital gains tax, which is less. And you might think, well, it's 19%. Jamie, yes and no, but within a company, it's very, very easy to make a loss. Okay, so there's loads of videos I've done on this. Profit and loss are paper exercises. It's not reality. I could guarantee you. So it's just a paper exercise. So what's within this is you're getting all of the expenses on this that are protected. So everything that is in that business where you are doing a refurb on another one, so it's offsetting the costs on this. It's not taken in isolation of the property, it's taken in that corporate structure. Okay, quick thing on that. If you do a single transaction that you've got one property that sells for more than £2 million, not many of us do that, but if you do, there are special rules around that. So make sure to look into it because I don't know the intricacies around it. I've never sold one unit for £2 million that I've bought, but look into that. But the other thing that's really cool here is if you own this company for more than 2 years, if you ever sell the company, i.e. the properties within them, first of all, there's a couple of things. When people buy it off of you, often they won't have to pay stamp duty. That's another tax issue to go through later. But because they're not buying property, they are buying a business that happens to own the property. I'm really trying to enforce that, but there's a lot of tax issues around it. But so they likely won't have to pay stamp duty on it. You will sell the company and there is capital gains tax because then you are selling an asset. But the great thing is when you've owned the company for 2 years or more, you can then apply business asset disposal relief. Business asset disposal relief. Now, I know a lot of you won't be thinking of this right now, but it is really important. And the reason I had to look at that is it used to be called entrepreneur's relief. Okay, so entrepreneur's relief, if you are building a small business up and you own it for 2 or more years, you can get a fairly significant relief on your tax, okay? And it is pretty big, okay? So, but business asset disposal relief. So let's just go through a worked example and break that down on how it would work in this instance. Going through a worked example, because I really just want people to get in their head some of the numbers. If you buy a £100,000 property and you put in 20,000 on it, you put in 120k, right? If you then sell it at 150,000, I know this is pretty simple, but it's good to get your head around. If you sell it at 150,000, you don't pay tax, any tax whatsoever on the 150,000. You will have 150k minus 120k, which is 30k, minus cost of sales, COS. Let's say 5 grand for solicitor fees, estate agents, etc., which is 25k. And then you pay capital gains on that. So even if you didn't have any loophole, there's 12,300 on that, which is tax-free, 0. And then the remaining 12,700, you're going to have an 18% tax on that. If you are a lower tax bracket payer, and 28% if you are a higher tax income earner. So at 18%, that's going to be 2286 in capital gains tax and 3556 if you are a higher income tax earner, okay? Because remember, income tax is going to affect the level that you're paying capital gains. So what you do need to remember to tie all of this off is that's if you don't utilize anything at all. There are ways where you can split the capital gains relief. There's ways that you can have this in a company and mitigate that. You can look at the losses across other parts of your portfolio, maybe your holiday home, I was going to say in the Hamptons in the UK, your holiday home in Surrey or Devon or wherever you've got it, and just make sure that you're looking at this as a whole. Talk to a tax advisor because they are going to be able to actually give you proper financial advice personal to you, because tax is personal. And most importantly, when you're looking at doing this, you need to remember the most effective ways of scaling your portfolio quickly, which is by subscribing to this YouTube channel, hitting like on the video, and it will help it reach other people just like you. And if you are interested, watch the other videos that we put in the description below and let me know what you thought of this in the comments, and I'll see you in the next video after you subscribe.